the biggest picture thing I focus on over the past few years is this concept of the long-term debt cycle. And that was originally popularized by Ray Dalio. And one thing I did was, I would see his charts and see his explanations, and I said, okay, that actually answers some of my questions. But I want to go in and determine, is this accurate, and can I explore this from other angles, and how can I quantify this in other ways?
The number of active wallets in crypto grew 42% in a year when the market went down 80%. That's like, oh my God. We're now at 516 million users. By the end of 2030, we'll be well over 1 billion users, maybe 2 billion users.
Yeah, we had a very kind of still levered environment, high populism, slowing economy, ran into COVID, and now we have war. Both those environments, you generally get very, very large fiscal responses, right? Because it goes up to that level. And that's where you get that more inflationary or stagflationary type of situation. And so I've been making a lot of parallels between the 2020s and the 1940s, and as well as the 2010s to the 1930s. And unfortunately, that does continue to play out. And in some cases, it has even become more literal. Now that there's some degree of kinetic war happening. It's a different phenomenon because credit contraction on its own is more disinflationary. That's kind of what we've seen in Japan, for example. They've had money printing at like the sovereign level, but they've had significant deleveraging at the corporate level, both in terms of increasing their cash allocations and decreasing their debt levels. So they've been a lot of it has gone towards net debt reduction, and that's been an environment of low money supply growth. And generally stagnation. Same thing for like the 2010s and the 1930s. You had a reduction in the amount of debt relative to GDP among the private sector, and so that's generally a more disinflationary environment because you have low demand for things, or at least slow growing demand compared to the prior trend. And the issue is that one is that commodity cycles work themselves out over time. So those are environments of say commodity abundance and low demand, and then the problem is over time you work through those reserves that you've built. There's not a lot of not necessarily a ton of new capex coming online. Demand is slowly increasing over time, and eventually you run into the next commodity undersupply cycle, which is generally a more inflationary cycle. And then the problem is you're now running into that environment when you have super high sovereign debt level, right? So you have that tension between you're supposed to raise interest rates when you have inflation, but now you have over 100% debt to GDP, and you have a very highly leveraged system, especially when you look out in parts of Southern Europe, you look at Japan, as well as here in the United States.
We're at the bottom of the business cycle. This is the kind of recessionary era. Businesses are laying off staff. Inflation is starting to fall sharply. The forward-looking markets, technology and crypto, priced in a recession last year. And they've been recovering since because they've been following the forward-looking indicators of financial conditions and other things. Right now, stuff like the Russell 2000 and oil is living in the present day, which is slow economy. So they're at their lows, and everyone's like, what the hell is going on? Why are these tech stocks going up and everything else is going down? It's because they're forward-looking, as it is their job. So I've been very bullish. I saw the liquidity cycle, which is the key driver of all assets. The liquidity cycle is based around this interest rate cycle, which is based around this whole debt refi cycle. Liquidity started bottoming last year in October, November, December, and that gave us the signal to start getting long both crypto and technology. And that's been, phenomenally good. I mean, this year, the Nasdaq's up 45%, and crypto is anywhere between 80 and 500% this year. And that's got people scratching their heads. But our forward-looking indicators of the business cycle suggest we're going into what is, right now we're in macro spring. That's when the weather kind of gets warmer every day, but sometimes it's raining and sometimes you've got a frost and other times it's hot and you're like, it's always confusing. That's macro spring. We're about to start moving towards macro summer. What is macro summer? Macro summer is when interest rates are falling, inflation is falling, and growth is picking up. That's the kind of holy grail for macro and for investing. And we should be in macro summer for all of 2024 and into 2025. My forward-looking basis is that the economy picks up, inflation keeps falling. I think it'll overshoot to the downside, which is the opposite of everybody else's narrative of sticky inflation. And I think the markets are already showing you how excited they are about this idea, because we've just gone through a ridiculous rate cycle, kind of an unprecedented rate cycle on the back of the unprecedented inflation. That inflation, I think, was just driven by the pandemic. If you shut down, all demand and shut down all supply and then bring it all back on at the same point, you create chaos. Exactly the same happened after World War II. After World War II, suddenly everyone came back into the labor force and factories had to retool from making munitions to making cars and washing machines and whatever. And we got a massive inflation then. But then what happened is it worked its way through and we just had strong growth going forward.
Pal believes a global economic reset happened in 2008, with the world's major economies coming to the realization that the two most important factors for GDP growth, demographic and productivity growth, are either flat or declining. Yet debts have kept piling up, hitting 100% of GDP for most of these economies at different points since then. To delay the inevitable, Pal believes central banks decided that the best course of action was to put the debts on their balance sheets and print money periodically to keep the fragile economies balanced. But by doing so, they passed a point of no return and have to continuously and constantly provide liquidity to protect the balance. The former Goldman Sachs executive is certain that the U.S. Federal Reserve has kept its hawkish stance for so long because they want to break something huge like commercial real estate, so they will have enough excuse to get rates back to zero and start printing again like crazy. According to Powell, the other option, leaving interest rates high while the debt and debt expenses keep climbing rapidly, is completely unimaginable. But money printing is only a temporary solution. This is where technology and cryptocurrency come in. Artificial intelligence and robots will provide the needed demographics that will live and operate mainly in the digital space. Cryptocurrencies will be the commercial hub that will help everything thrive. Let's get back to Powell's video as he discusses the rapid pace of adoption of cryptocurrencies and what's coming in the next few years.
Crypto side has been, outside of AI, the fastest adoption of any technology in all of humanity. It has been following a perfect log trend. And what was staggering is last year, the number of active wallets in crypto grew 42% in a year when the market went down 80%. That's like, oh my God. We're now at 516 million users. By the end of 2030, we'll be well over 1 billion users, maybe 2 billion users. So it is a very prevalent technology. And it's happening this cycle everywhere, kind of everything everywhere all at once.